Hello, everyone. Welcome to our webinar on one company's solution to improving capital access for entrepreneurs. I am Jennifer Rabb, fellow at the Baker Institute and director of the McNair Center for Entrepreneurship and Economic Growth. The McNair Center focuses on the public policy angles of government regulation, tax policy, and the capital market for small businesses in the United States. Today, we will be talking about the difficulties small businesses encounter as they seek out loans to start, grow, or operate their businesses. Today's webinar is the first in a series in which we will explore the for-profit, nonprofit, and governmental approaches to capital access. Today, we start with the for-profit approach, and our guest is Eric Griego, co-founder and CEO of Betterfin, a platform for business owners looking to secure commercial financing. Eric, welcome and thank you for being here.
Thank you. Glad to be here.
So to get started, will you just tell us a little bit about Betterfin?
Sure. So Betterfin was a company that started in San Francisco. It's a platform for small business owners, and our focus since we started has been to help them get financing. That has obviously expanded into the way we work with lenders. Some of them are banks, some of them are non-banks, but also in the kind of suite of services and product features that we offer small business owners on our platform.
So one thing I've noticed is that Betterfin's services are free to small businesses. So who do you consider your customers and who do you consider that you serve? Are those the same people or different people?
Yeah, so that's a good point. So our customers are small business owners. I guess to define them, we really focus on smaller businesses. We kind of define that as having, somewhere less than 20 employees, somewhere less than $10 million in annual revenue. And we kind of sit in between two parties. One is obviously the people, these companies, these small business owners, but the other side are lenders. So a lot of the work that we've done with our technology platform has been integrating our platform into decision underwriting and different endpoints with these lenders. Our sort of marquee experience for a business owner is something similar to what you've probably seen out in the market where you're getting a mortgage or auto loan where you can, sign up, share information, and then you're presented with sort of a palette of different options. I think where we've gone and done a little bit of differentiation has been we've actually taken the time to integrate with these partner lenders. So when a business shares their information with us, we're often going out and doing complicated things like pulling credit reports, pulling commercial credit reports, consumer credit reports, analyzing them, pulling in financial data, accounting data, payroll data, and then a lot of that we do in collaboration with our partner lenders through back-end technology. So the actual business owner, is provided with a very robust set of actual offers, contracts, interest rates, deal terms, pricing, so they can make, what is a pretty significant financial decision. So in our business model, we actually get paid by the lenders. What's great about that is we don't have to pass on any cost to the business owners. So it's really kind of a win-win-win. From the lender's perspective, they're getting customers, they're meeting business owners who are well qualified for their financial products, and we're helping them expedite the entire process through our technology.
So when Betterfin started out, or since you've been in business, what are the barriers that you have seen that small businesses face as they try to acquire loans? And so what problems are you trying to solve?
Yeah, so there's a number of different things, but I would say probably the most prevalent is just financial literacy. So when we talk about businesses, that are on the smaller end, a person's a lawyer, they're a really good lawyer, they know the law, they're a plumber, they know everything about, pipes and plumbing. But where they often don't have a lot of experience or acumen is on the financial side, doing FP&A, if their business has to scale by hiring, or if they have to, get paid by invoicing. All of these things can present, a significant sort of financial situation where they have to navigate exactly how they're going to, pay for things, manage their cash flow. So that is kind of our number one problem that we set out to address. So if getting a loan, isn't just as easy, as just applying and being given a pile of money. You kind of have to have a plan, what you're going to do with the money, when's a good time, how to position your company's financials in the best, place to get the exact kind of financing you need. So a lot of what our platform does is sort of handhold them through that. These companies are too small to hire necessarily like a CFO or maybe to even have an accountant in staff. So we provide sort of a middle solution that empowers them to do these things really well, get a lot of transparency, and sort of make sure that they understand the ins and outs of what they're getting into when it comes to financing.
So one thing I understand about your platform is that you expedite the application process, or maybe it's say you make the application process practically non-existent. So I understand business owners spend a great deal of time on one loan application, not to mention several loan applications.
Yeah, that's true. So um, small business lending, unlike other loans, whether it be auto or mortgages, are really well known for being unregulated. Meaning, when it comes to consumer loans, you have something like the Fair Credit Reporting Act that sort of um, makes this sort of standard application process, what data can and can't be used. In the world of commercial lending, it's really up to the lender to decide. Even the SBA, the guidelines and rules they put out are somewhat up for interpretation. And really, any lender can decide how to underwrite a loan, however they want. So if you're, a dentist, you could go to two different banks, have a completely different experience where they look at completely different, attributes within your credit and financials, and they might give you completely different pricing terms. And that's just sort of a byproduct of the fact that there's not a lot of standardization when it comes to commercial financial products.
So is it the case that with Betterfin, if a business uses the platform, their their day-to-day transactions are part of the platform, and so when they go to apply for a loan, the information is already there? Is that how it works?
Yeah, exactly. So when we register a company, what we're in effect doing is allowing the Betterfin platform to have access to the relevant, data points within your credit reporting and financials that lenders want to look at.
Mhm.
But what you actually get is sort of this real-time um, feedback loop from lenders saying, look, here's why you're qualified, why you're not qualified. Here's why, you're approved for this amount of money or a different amount. Here's why interest rates are where they are. And, these things might come down to things you'd expect, like, how much revenue the company is making, how consistent it is. Other things, might not be so well known. There are some lenders who have completely different rules when it comes to lending to certain industries or different, states and things like that. So what we try to do is, very similar to something like TurboTax, where you don't need to be an expert when it comes to all these different IRS forms and different IRS rules to file your taxes. But we can kind of empower anybody to do it accurately and make sure they're getting kind of the most up to date and accurate information.
Right. So has the company done analysis on how much time you save your businesses that use your platform and in acquiring a loan?
Yes, so I think for most of our products, we basically cut the time in half. And I think the number one thing we do that is extremely helpful is because we have these sort of back end hooks into our lenders and their underwriting. We essentially don't even bother people with going through the application process unless they're going to be qualified. So, a lot of the times what we're actually doing is saying, hey, you're not actually ready yet, but here are the next, 5 to 7 steps you need to do over the quarter, half year to get yourself in position. And we basically start the dialogue with the lender early, so the business owner can kind of work on the different pieces they need to put into place to get the financing they ultimately want. So we have a really high approval rate when we actually, get our customers into financial products. We save usually they save around, somewhere between 3 and 5% in interest. So it's pretty helpful from like an economic standpoint because, for the lenders, they don't have to send this business owner through their entire funnel of dealing with salespeople, dealing with their underwriters, going through their operations process. So it saves them a great deal of operating expense, and we're able to kind of pass it along. So yeah, I guess to answer your questions, they're very much options that you can get through the Betterfin platform that you can't get from that same lender by approaching them directly, which is pretty unique. But also when it comes to saving time and money, there's definitely a meaningful impact.
So do you have any data on whether the loans you facilitate prove to be more or less risky than loans made through conventional channels?
Yeah, so we work with a number of different lenders who sort of span from, I guess, bank financing, working capital, all the way on the other spectrum, which would be, like equipment loans that are collateralized and things like that. So it is a little bit difficult to say, but overall, I think how this plays out is that because we don't because we don't really allow borrowers to go through the process unless they're going to be qualified. They essentially are, in the sort of highest tier of when it comes to performance. So I think we were looking at a statistic uh, from last year, and the number of defaults that we've had on loans that we were able to kind of facilitate through our platform is like in the low double digits. So it's very very low default rate. So to answer your question, much less riskier.
You touched on this before, but is there a business profile that best matches the Betterfin platform, or a size or type of business that finds the platform most beneficial?
Yeah, so I mentioned the less than 20, employees, sort of 10 million in annual revenue and under. I guess to expand on that, I also mentioned, hiring, with hiring. So, different kinds of companies that have to scale through actually hiring um, more like human capital. So, like service companies that, construction, even like digital agencies, right? More you need more employees to take on more customers. That is a pretty big cohort because a lot of the times they don't have the capital to hire, but there's also the business opportunity to do it. So financing is a way to leverage and get access to that. The same goes with invoicing. So there's a number of different industries where it's just kind of commonplace to you don't get paid for your services when you conduct them. They get put on 30, 60, 90-day net terms. And that a lot of times can cause cash flow issues for a lot of companies. So services, as a sort of high level industry type is a really big cohort for us, mainly just because the way they conduct their business, these kind of cash flow issues always arise.
So I'd like to talk about Betterfin's partnership with the Small Business Administration's Small Business Development Centers. That's really a mouthful.
Yep.
SBDCs. And just by way of background for our audience, there are 62 SBDCs, these small business development centers around the US, and they are a joint effort between the Small Business Administration and local organizations to serve the needs of small businesses, including financing. So there are 62 around the country, currently 4 in Texas, plus a number of satellite offices. So that's the background on SBDCs. So do I understand correctly that SBDCs use Betterfin's platform for client intake?
Yeah. So essentially, you have these advisors who are sort of peppered throughout the states, and they do a number of different things from vendor procurement training to licensing and different kind of city and state regulations for business owners. But one of the genres of consulting or advisory roles they play is when businesses come through their front door and say, hey, we really need to find capital. And it can be a lot of different types. I mean, I think they help on venture deals, raising money from VCs to, any kind of corporate debt. I know they've helped people become employee-owned companies. So that small vein where the businesses are looking for traditional commercial financing, yeah, we've given them a version of our platform for free. I think we have 3 out of every 5 advisors are on it, and at some point, during the year, they will have a customer that needs help getting financing, and they have kind of access to all of the tools in the Betterfin toolkit. So, whether it be their customer needs to look at their credit reports or do some kind of cash flow analysis, or they're ready to get financing and they want to actually start talking to a lender and find out what their options are. Yeah, we've kind of given them a workbench to do all of that. So, that's been really great. I think um, there's a lot of businesses who, don't fall in the traditional um, channel where they're extremely savvy when it comes to going online and finding solutions that way. And so to be able to go somewhere in their local community and meet with an advisor, meet to someone face to face who they can trust, and then still get access to technology, I think that it's given us access to a lot of business owners who we typically wouldn't meet because they're just somewhere in the world that isn't keyed into kind of the mainstream of commercial financing.
So it seems that strikes me as a really tremendous opportunity for Betterfin, a great way to get businesses that need you on the platform. So how did the partnership with SBDC come about?
Yeah, it actually happened pretty organically. So we first partnered here in our company's based in New York. So the New York SBDC has somewhere around 250 employees, around 200 advisors, I think something around like 37 different centers. And it started working just here locally with New York. And I think that from there, we kind of were able to go. New York's one of the older, one of the oldest sort of SBDC cohorts in the network. And from there, we were kind of just able to jump kind of state to state to state. And really, I guess over the last 18 months, I think we're working with an SBC organization in every state, a few international, that do import and export. And well, yeah, like I said, we have 3 out of every 5 advisors on our platform. So it just kind of happened organically. And you know, one of the things that people don't, or I guess people don't put a lot of weight on, is there is a really strong need for business owners to be able to meet with some. I mean, that's kind of changed over the last year, but pre-COVID, SBDC advisors are very engaged in their local market, right? They know Chamber of Commerce, they know, all the different state organizations that business owners have to deal with. So they're a pretty big presence in that scene. So um, it just kind of happened organically, but it's been a great partnership. We're
So
very like,
is that an exclusive partnership, or are there other companies similar to Betterfin that also have their, are utilized by SBDC advisors? Do you know? I
so
don't mean to make
yeah,
you talk about your competition, but
no, not at all. I think there are a number of different companies who are doing something similar. I think the difference between us and them, and maybe what the SBDC folks would say, aside from all the technology stuff, is that we give them all of this for free. So, whether a state has a couple hundred advisors or a couple thousand, we're committed to doing this for free. And I think that's a big deal because they are funded federal dollars. They don't have huge budgets, but they do make a big impact. And so, for us to be able to kind of get our lenders on board, for example, when when COVID happened last year, we worked with a number of our partner companies, to put together a care package. A lot of the advisors in the SBDC network weren't able not able to, but weren't prepared to work from home during COVID. So we worked with a couple companies, with Google, with Zoom, to basically send a number of advisors a care package with like a free laptop and access to all the tools they need. So I think really it's just been the commitment to, sort of send them what we can, for free. Whereas, I think they work with other companies, in more of like a paid capacity. But for us, our goal has always been to get this into the hands of business owners for free. We think the SBC advisors are amazing stewards for that. And so luckily we've been able to work with our, partner banks and lenders to make that possible.
So I think it'd be great to get a sense of how much need there is in the small business sector for help obtaining financing. So can we just start that with, can you give us a sense of how many small businesses Betterfin serves, which you may already have mentioned, like how many businesses you have made loans to, how many dollars you've loaned in total?
Yeah. So in a given year, we will help facilitate anywhere between 30 to $50 million in loans. I guess, that doesn't sound like a lot, but given that we focus on kind of the smallest of the small, our average loan size being, maybe less than $30,000, it's a significant number of loans. And then, at any given time on our platform, we've probably got another, I don't know, 60 to 70,000 business owners who are sort of in progress. So they're either working on their credit, getting their financials. Sometimes a lot of the reasons why they don't qualify, for example, an SBA loan, you have to be in business 3 years. So a lot of businesses are just waiting to hit that kind of milestone before they actually jump in and apply. And fortunately, we have the right kind of tools for them to kind of manage all of that on our platform, while they wait.
And do they have to have been in business 3 years to get a loan through your platform also?
No, so
No.
we work with a number of different, well, some do, yeah, for SBA loans. A lot of SBA providers won't do that for businesses who are, not 3 years. But the point is that, we work with, um, I think 51 is our roster right now, 51 different lenders who will focus on different products, different credit tiers, different geographic locations. And so within that, there's always something you can qualify for. I guess the goal of the platform is to try to help you to make sure you pick, the right financing option that sort of suits what you need, right? A lot of business owners think, hey, I just need a loan for $50,000. Well, why? Oh, I want to buy a car for my business. Oh, well, actually, you can get an equipment loan, that's specifically built to buy a vehicle that's much cheaper, that's much easier. They just don't know that. So
Right.
that's kind of what I'm referring to.
So how much overlap is there between Betterfin's users and the SBDC clients?
Yeah, I would say that at this point, 1 out of every 3 customers is coming to us. They're coming through the SBC channel.
Okay.
That's pretty significant.
Yeah, it is. So how much more unmet need do you think is out there? Need that's not met by SBA or Betterfin or somebody else?
Yeah, so that's an interesting question. I mean, there's definitely, when it comes, I mean, when you look at the different debt markets, like you've got, housing and student loans and auto loans are well over a trillion, $2 trillion. Commercial capital, has always kind of slowly moved between 500 billion and 1 trillion. And, there's probably about double that in demand. The question becomes, if that unmet demand is actually, you know, um, if it's good risk. I mean, at the end of the day, one of the easiest things to do is start a business. Whether or not all of them, are suited to actually take on debt and be able to pay it back is another question. Um, but I would say that probably, um, probably what probably all of our volume and all of the businesses that we work with are coming to us because something is happening in the mainstream that they're not getting what they need, whether it be, hey, I really want this bank loan, but Chase is going to take 5 months to approve me and fund me. That's a problem, right? Nobody ever needs money 5 months from when they go looking for it. So from that regard, I think there's substantial, but it's really hard to say. What I can say is that every lender we talk to, every even like with the SBC, probably like for one person who actually goes and gets a loan, there's like five more who want one who for whatever reason aren't able to get funded.
Okay. So as you know, the Baker Institute is dedicated to public policy research. So let's talk about changes in public policy that could potentially help address that still unmet need.
Sure.
So do you think that that we need more alliances like between SBDC and private companies or similar, government and for-profit kind of partnerships? Do you think that would help?
I think it could help. I think, I mentioned this earlier that small business financing, I guess commercial financing, is highly unregulated. And that's one of the main reasons why, industries like the merchant cash advance industry is, somewhat thriving, right? Predatory loans are thriving. Um, and so, there's a number of things I think. I think one is, you know, banks like Chase can't, for regulatory reasons, for policy reasons, can't do merchant cash advance. Now, I know that sounds like a weird thing to say, but I think we'd rather have like a good actor doing a known bad product than we would just leaving it to bad actors doing a bad product. So, I think that if we could change policy to allow more financial institutions to do more types of lending, I think that that would open a significant amount of doors for business owners to have more options from good institutions who can do, different kinds of products they can't do today. The second thing I would say is, I don't know where things are at exactly, but it sounds like we're on the verge of allowing companies like, Square and PayPal and different fintechs who are in the payments and lending industries to become banks. And I think that's important because when I look at PPP, you know, I think like three of the top 10 PPP lenders were technology companies who do nothing in banking, who have no deposit business, who have no branches. And I think that that is telling of the fact that really what they were good at was being able to, build something quickly, in response, to adapt on the fly. And, for a fintech to really compete with these legacy banks in PPP is just to a testament that they're probably better at doing a number of different things. So I think that, for there to be kind of a special charter for fintechs to be able to do more banking activities is only going to benefit lending in general. We'll see, probably most companies will become a fintech company of some kind. And for some of them to be able to become banks, I think that's only going to improve the access to capital over time. So, like an example of that would be, I don't know, if you're Shopify business, right? Wouldn't it be great for Shopify to just be able to lend you money, without having to go through some kind of third party bank and have to, do it the way that that bank wants. They were their own bank with their own financial fintech charter. It'd be interesting to see what they could do to help, more businesses. I guess the last thing I would say there is, I've always been fond of the Community Reinvestment Act. The way that this plays out in commercial financing is there are institutions like community development funds who are able to give loans to credits or cohorts that maybe a traditional bank wouldn't be able to do. But they're always they're always very limited in how they can operate, how they can get access to more capital. And I think that if there was new policy around how those companies could work with companies like mine, it could be interesting. It could be very interesting to see, how much more capital could get into the hands of, certain demographics that are sort of marginalized by traditional banking.
So have you seen changes in public policy that are that really have been brought about by business models like Betterfinns?
Um, Not to a degree. So, I don't know. I think that at the end of the day, maybe what we could be sort of watered down to is a glorified broker, right? We kind of sit in between business owners and lenders, and we sort of, um, make the deal happen. And so, in that regards, there has been some changes over the years that have allowed, I guess, brokers to do more, to work with more different types of lenders. Um, but ultimately, I think that regulation would be helpful. Um, One of the advantages that consumer lending has, and maybe the reason why it's so much bigger, besides the fact that there's more people in our businesses, is that when you can go to any mortgage lender in America and you know exactly what information they're going to look at, why they're going to say yes or no. And even in some cases, it's like your credit score has to be X to get approved, right? It's like it gives people a lot of transparency and a lot of convenience when it comes to planning to get a mortgage to buy a home. That's just non-existent in commercial lending. So I think that if there was some standardization around, how we use credit reports, how we use financial data, and there was, some kind of commitment from lenders to, adhere to like a common app or something like that. I think that is something that would be really helpful for business owners to sort of know, hey, I want to get a loan, and it's just sort of a well-known thing. Here's what's going to have to happen for that. Whereas right now, it's sort of a guessing game. You have no idea. Lenders can change their policies from year to year. You get a loan with a lender today, and a year from now, it's going to be a completely different story. So that just presents the lack of regulation. I think presents a huge challenge for business owners to get capital.
So usually in the McNair Center, we're not we're thinking that more regulation is a bad thing, but what you're saying is that as painful as the the mortgage application process can be, and I personally know how painful it is, it's better than what business owners go through.
Right. Yeah.
That's interesting. So why is it that you think that kind of standardization does not already exist?
Well, I mean, there's a lot of reasons. For one is, I think it's very difficult to sort of it's sort of it's very difficult to write legislation around quote unquote businesses, right? Here in this country, we have, first of all, we have different types of entity. Our entity structures, I think there's something like 46 different types of entities. Now, that being said, most businesses are going to be some kind of corporation or LLC. But at the same time, there's just like there's a lot to work with. So it's very different from consumer financing in that regards. And then I think the second thing is, there's a significant amount of lobbying that goes on in commercial financing, right? Um, Especially like the cash advance industry has an enormous, lobbying arm that does a good job at sort of keeping deregulation away. So, I guess if I had to guess, why it doesn't exist, there just hasn't really been enough need for it, right? I think that right now, you were to go to any given bank and say, how committed are you to tripling your commercial lending business? I think most of them are not. And that's just because until there's, regulation that I guess helps, like I said, someone like Chase do other types of financing products and that business gets more profitable, there's just not going to be a lot of interest or momentum behind, adding regulation to a place where I guess, no one's really asking for it. But I do think that what's going to happen is, that might not even need to happen. There's a number of different platforms who, in my perspective, sort of outsize the banks, right? If you take platforms like Square, PayPal, Amazon, there are probably more businesses on those platforms than probably have bank accounts with a lot of the banks. And you know, if those companies could offer banking services like a bank account, and different payment services, I think that within those sort of ecosystems, you could see them um, doing exactly what I'm saying, right? I mean, I know Amazon Capital, I think, was the fastest growing small business lending operation to ever grow. Um, but that's because they had so many business on their platform and they had all the data on them. They could just sort of poke them and say, "Hey, we want to give you a loan." So I think it's going to be interesting to see what happens. But yeah, I mean, I think part of the reason why this regulation hasn't come is just there's not a lot of momentum behind doing it, given the other kind of priorities in the stack.
So one problem that you've mentioned, and I've seen on your website that Betterfin tries to help businesses address is poor credit. So I understand you have like a credit repair kind of service as part of your platform. Is that right?
Yeah,
So is there anything that public policy can do or should do to help with credit repair?
yeah. So this is going to be kind of a broken record, but credit, first of all, is a very strange thing. It's sort of created by these private companies, but then it kind of blends into legislation and sort of like federal policy. And it's never clear exactly where one ends and where one begins. At the end of the day, Equifax is like a publicly traded company, but if you were to go to a government website, they would refer to it as if it's sort of part of what you need to do in the financial system. Um, but when you look at commercial credit, right, everybody has their consumer credit reports tied to their social. But when it comes to commercial credit tied to a business's tax ID number, um, it's really up to the bureaus to kind of do that however they want. So if you were to go to one lender, they might say, "Hey, we use the Equifax commercial credit report." Um, and you go to a different one, they say, "No, we use the one from Dun and Bradstreet." So what's been great about consumer credit is that it's sort of been, there's like ubiquity around it. So you can pull your credit report from all three bureaus. It's all going to be the same data, same sort of apparatus, same infrastructure around it. They all play by the same rules, right? You have 7 years, things fall off. You can same dispute process. You write a letter. None of that exists in commercial credit. So it's very hard for a business to say, "Hey, not only do I want to establish, my commercial credit, but what are the rules? Like, what would I have to do to report something? What do I have to do to dispute something?" It sort of doesn't exist right now, and I think that's one of the ways that policy could help quite a bit.
Makes sense. So one thing we're looking at in the McNair Center is the application of blockchain technology to that capital access problem. So I wanted to ask if Betterfin uses blockchain.
Currently, don't. Um, I do think that there is an opportunity, and specifically, when you take a part of the supply chain, right? Like you have some silicon mines selling silicon to Intel. They make chips, sell them to Hewlett Packard. Hewlett Packard makes computers and sell them to Office Depot. At every step, there's just a ton of invoices. And it's really up to each company to use whatever financial platform they want to do invoices, ERP. There's a number of different solutions. But if all those invoices were on the same ledger, a company like Hewlett Packard could say, "Well, we owe Intel $1 million for our chips, but Office Depot owes us $1 million for the computers we sold them. All of these invoices are on the same ledger, so why don't we just net settle, and that $1 million just kind of that's owed goes against the $1 million that we need to pay. And why that's I guess somewhat impactful is because right now the way that all that works is, well, if I want to pay that invoice, I've got to put money into a bank account. They're going to charge me for that. I need to move the money to someone else. They're going to charge me for that. And then both sides have to pay for technology to manage all of this. And then both sides probably have to pay for somebody to do this sort of function at our companies. So there's just a lot of inefficiency. And I think that that is kind of the most obvious place where blockchain technology could make a big impact.
So earlier you mentioned PPP loans, the Paycheck Protection Program loans, which was one, part of Congress's pandemic response to help small businesses stay afloat. So Betterfin helped businesses apply for PPP loans during the pandemic. Can you tell us about that?
Yeah, sure. So, if you look at maybe one of our most complicated, like SBA commercial financing loans that we do, there's a ton of taking information, putting them into the right, IRS forms and government forms and SBA forms, electronic signature, and then there's the opposite where we take in, different documents and convert them into data. At the end of the day, that's all the PPP application process really was. So we kind of pointed our technology towards the specific, ins and outs of that program. We built a tool called Ready Relief. It was just sort of like, get ready, to get relief. And, it was a lot like TurboTax. You just kind of fill in the blanks and we generate your whole PPP application. And, we did a lot of that kind of directly with our users, but I think the big thing was making that available to the SBC advisors in the platform. So yeah, that was kind of our main offering. Worked with a number of different lenders to actually fund the PPP loans, but it was a great piece of technology, and it just kind of shows that like I said before, um, that was something that even like I think Wells Fargo didn't have. They might have a place where you can go and sign up, and then you're gonna get put on the phone and fax documents. But just a testament to like I think technology focused companies are able to handle, or I guess better suited to quickly build solutions for problems like that.
So how do you think programs like PPP should be done differently in the future?
Yeah, well, there's a number of things I guess I could
How many
say.
ways, right?
Right. Yeah. I mean, look, they had a really tough job. I mean, more money has been printed in the last 18 months than there's ever been. So, getting all that money out to people is no easy feat. There's like a lot of fraud. Um, the SBA probably wasn't exactly ready for the sheer volume of just requests and transactions that they were going to get. Um, but I think the bright spots were, something they didn't do right away, which is at first it was going to only be, SBA registered banks who could do PPP. And then they opened it up to everyone else. And I think when they opened up to everyone else is when like the PayPals, the Cabbages of the world got involved. And that's why those, they became the top PPP lenders, is because through technology, they were more equipped to handle the sheer volume. So um, I think that that is something that they should recognize, and they should definitely plan um, in the future. I think it's like kind of unquestionable now that the organizations who are more equipped to use technology are often going to be the most impactful. And I think that's something they should take into consideration just going forward when it comes to any kind of, new programs or anything like that. It did make a huge difference.
So it sounds like we're coming to a conclusion that what it takes to serve the needs of small businesses and meet them where they are is technology.
100%. And I think that you know, even the fact that, we've built all this technology about just getting, something as simple as an SBA loan, to happen within a reasonable time period is, probably testament to anything that they should be thinking um, ahead on how they can leverage technology or leverage other companies and technology. Because, I mean, just imagine if you had a product that an entire other company could build a business out of just making your product like quicker, right?
Mhm. Yeah, so I didn't ask this earlier, so I didn't think to ask it, but how much does your platform shorten the time from application to funding
Yeah,
for a
so with
business?
one of our strategic partners, our goal is to try to this year to try to get a 7 business day SBA loan, which I think the industry average is somewhere around 45.
Uh-huh.
So it's pretty significant.
Wow. Wow. Right. Well, let's turn to questions from the audience,
Sure.
if you don't mind.
Yeah, of course.
Um, okay, so first question from anonymous attendee. Do you work with startups? In other words, businesses that are pre-revenue?
Yeah. So that has been a really high growth sort of cohort for us within our customer group. Essentially, there are no magic tricks. Like there are no banks who want to give a business loan to a business that has no revenue. But there are different institutions who will take into consideration, like, the owner, their personal finances, collateral, a really good business plan, um, those types of things. So, short answer to your question is yes, but it's very different from, your run-of-the-mill commercial financing. It can be very heavily reliant on, the business plan, the founding team, their financials, things like that.
Mhm, mhm. I'm sorry, I should have mentioned to the audience, if you have a question that you'd like Eric to answer, please type it in the chat and it will find its way to us. So next question, do you have a partnership with SCORE that's similar to the SBDC?
So no. So there are some score small offices that we work with, and similar to score, there's like veteran centers and women's business centers that we work with. But it's not kind of on the level as score. I think primarily is because there is a very specific and pointed part of SBDC advisory role where people are coming to them and saying, I want capital, and they need to help them find it. Um, where, score might be more, you know, specific on, fixing credit or something like that. But very familiar with score. I think they do a lot of really good work. Unfortunately, we just haven't been able to engage them on the level that we have with the SBC.
So I know that in 2019, Betterfin partnered with the New York SBDC
Hmm.
on an innovation pitch competition.
Yep.
And can you tell us a little bit about that?
Yeah, so I think I mentioned this earlier, but the New York SBC has a couple hundred advisors. They're all generalists. I think some of them specialize just through previous work in banking and in international business and things like that. But the premise was pretty simple. It was like, okay, Betterfinn is gonna put up a bounty. The SBC advisors are all going to kind of put together a number of different teams and pitch on where the money should go. And there were some very specific, I guess goals or judging criteria. One was, just direct impact to the SBC, whether it be, helping people get capital or, number of customers able to help. And then the second one was sort of like, making sure that it's doing something net new, that we're not like, let's pay for a Zoom subscription versus whatever they had before, right? So it was great. It was like everybody get together in a big room. Everybody, very much pitches, a panel of judges, Shark Tank style, and then, it was a lot of hard deliberation, but essentially, it's just kind of a way for all these advisors to think, I guess, very creative and critically about what are the what are the things they'd love to have that they don't, that they think would make, a significant impact to the business owners that they see. Um, and, there were some really, really, really good ideas that came out of that. And I think that the New York SBC and then also the core group, the Americas SBC, looked at it as a really good exercise because there were some very some tangible changes that came from that for the better. And New York has always been sort of like a leader um, state group within the SBC. So before COVID, we had plans not just for Betterfin, but for the different state SBC organizations in general to sort of do this, to follow their lead and kind of do their own version of this. I think we actually did one. Um, we were able to get one done in Maryland with the Maryland SBC, but obviously all of this was sort of derailed through COVID. But the plan is as soon as possible to get this back on the rails. But yeah, it was a very cool idea. I think all the credit goes to a few people in the New York SBC for really championing it. But yeah, that's kind of the context and how it went.
Well, I'd love to have one here in Houston. That would be, I think it'd be a great learning experience for everyone.
Yep.
Let's see, another question from the audience. Does Betterfin work with lenders to monitor loans and know when loans go bad?
Yeah, so the short answer is yes. Some products are easier than others. For example, a line of credit is sort of like a credit card without the plastic. And so, we're very much in the know on how that's going. The other thing is there are a few of our loan products which require the business owner to essentially link their financials. So we can kind of help put together the cash flow story as the loan sort of progresses. And, we try to be as helpful as we can into knowing when these business owners need more money or, want to renew their loan. But we can also tell when, they're starting to miss payments and help put together some kind of workout situation. So, default is the last sort of step in a long line of things. But short answer is yes. So um, we can tell like, hey, we got you this loan a year ago. Since then, the Fed has cut rates twice. You could refinance and save some money. You could refinance and get, a much smaller payment. Those are kinds of things that we monitor after, the loan is sort of done, so to speak.
So a question from the audience, do you have any advice for entrepreneurs? Presumably that's related to securing financing.
Yeah, so I guess the best thing I could say in that vein is, you know, part of what I opened up with these business owners not necessarily having the experience or direct, acumen to go out and get financing is that you know, when I started Betterfin, I thought I was going to be product managing our product all day. And I probably spent many, many months, more than 40 hours a week on one thing and one thing alone, which is raising, money for the company. And I think that for business owners, that's going to be a really challenging part, right? I think there's a lot of business owners who are very talented at what they do. They have a great business plan, um, but you can't be two people at once. You can't be the person who's going to run the business and do the day to day, and also have a bunch of time to go out and meet investors, meet lenders, talk to them. So, my advice is to like have that planned out as well. As well as your business plan has kind of, how you're going to grow your company. I think business owners also need to have a plan on how they're going to actually raise capital, who they're going to talk to, how much they think they're going to get, how long it's going to take, that type of thing.
Okay, one last question quickly. Do you work with venture capital to co-lend / share risk?
Um, Not really. For the most part, we stick to debt, strictly debt. Um, banks who want to lend debt, they want to get paid back. Um, there is one small, I guess this might be helpful, but the SBIC, Small Business Investment Corporations, are a SBA-backed venture capital fund. And so, if you're not your traditional tech company, like um, you're not a Dropbox, or you're not, one of these tech companies, but maybe you're like where, I mean, I think their most notable was like FedEx, right? FedEx started as a small company. Um, Chick-fil-A, like, a small business who wants to franchise, who wants to grow. Um, and you kind of think like, well, I don't know that going to, Elon Musk is going to be where I'm going to get my money. The small business investment corporations are sort of geared toward that. They're sort of geared toward taking smaller to medium businesses who want to become larger businesses through, selling their equity through venture capital. So those are a few companies we worked with before, but other than that, I guess the answer would be no.
Um, would you be willing to share an email address or something with our audience in case they have any additional questions after we end today?
Yeah, sure, no problem. It's Eric at betterfin.com.
Okay, great. Thank you.
I'll type it in the chat right now.
Okay, thanks.
Everybody has it.
Well, thank you so much, Eric, for talking with us today. And I want to thank everyone for attending the webinar. Also, please mark your calendars for September 16th. We'll have the next installment of our series on capital access. And we will talk about the government and nonprofit approaches then. And also in October, we will have a webinar on the application of blockchain technology to small business lending. So we hope you can join us for both of those events. Thank you again for attending today. Goodbye and be well.